Assalamualaikum warahmatullahi wabarakatuh. My name is Irina binti Muhammad Idris. I would like to present about the challenge facing Islamic financial industry. Islamic finance has recently received considerable attention in academics and policy making. Started over 3 decades ago in the form of commercial banking, the financial activities conforming to Islamic law, as known as Sharia, have spread to investment banking, project finance, capital markets, insurance, wealth management, and microfinance. Although Islamic finance has survived well despite the obstacles and skepticism of the critics, it continues to face many challenges. There are several areas for improvement, given the significance of the banking and capital market sectors in the development of the financial system, and the following areas that need an immediate attention. There are 5 challenges facing Islamic financial industry. The first one, small assets and capital size. Second, liquidity. Third, limited scope. Fourth, concentrated banking. And the last one is weak risk management and governance framework. This is the first challenges facing by Islamic financial industry, which is small assets and capital size. Although Islamic banking have grown in numbers, the average size of their assets is still small compared to that of conventional banks. There are more than 60% of Islamic banks were below than 500 million in assets, considered to be the minimum for an efficient conventional bank. There are large institutions that have significant potential for efficiency gains due to economies of scale and scope, organizational efficiency, and lower cost of funding. Due to their small size, Islamic banks are unable to reap these benefits. The second challenge is liquidity. Islamic banks are operating with a limited set of short-term traditional instruments, and there is a shortage of products for medium to long-term maturities. One reason for these shortcomings is the lack of markets in which to sell, trade, and negotiate financial assets of the bank. There are no venues for security dormant assets and taking them off the balance sheet. In other words, the secondary markets lack depth and breadth. Since the needs of the market regarding liquidity, risk, and portfolio management are not being met, the system is not functioning at its full potential. The third challenge is limited scope. In the essence of debt markets, and this is the first challenges facing. The third challenge is limited scope. In the essence of debt markets, underdevelopment of equity markets, and lack of derivative markets, financial intermediaries play a critical role in the provision of Islamic financial service. Financial intermediaries not only are the main source of capital and risk mitigation, but also are expected to undertake activities with wider scope. The changing global financial landscape will require Islamic banks to go beyond their traditional role as commercial banks and develop areas such as securities, risk management, and insurance that are either lacking or functioning on a limited scale. The fourth challenge is concentrated banking. Islamic banks tend to have a concentrated base of deposits or assets. They often concentrate on a few select sectors and avoid direct competition. For example, one Islamic bank may specialize in financing the agricultural sector, while another might do the same in the construction sector, and neither attempts to diversify to other sectors. This practice makes Islamic banks vulnerable to cyclical shocks in a particular sector. Dependence on a small number of sectors, lack of diversification increase their exposure to new entrants, especially foreign conventional banks that are better equipped to meet these challenges. The last challenge facing by Islamic financial industry is weak risk management and governance framework. Several studies have identified weaknesses and vulnerabilities among Islamic banks in the areas of risk management and governance. Operational risks, which arise due to the failure of systems, process and procedures, is one area of concern. Weak internal control process may present operational risks and expose an Islamic bank to potential losses. Governance issues are equally important for Islamic banks, investors, regulators, and other stakeholders. The role of Sharia boards brings unique challenges to the governance of Islamic financial institutions. For the recommendations for Islamic financial industry, there are improvements that can be made in several areas to promote and enhance the functioning of Islamic banks and other institutions providing Islamic financial services. There are 4 recommendations for Islamic financial industry. The first one is financial engineering. The second one is risk management and diversification. The third one is non-bank financial service. And the last one is development of capital markets. The first recommendations for Islamic financial systems is financial engineering. Financial engineering is to introduce new Sharia-compatible products that enhance liquidity, risk management, and portfolio diversification. The attempts to apply financial engineering techniques to Islamic banking will require committing a great deal of resources to understanding the risk-return characteristics of each systems and offering new products with different risk-return profiles that meet the demand of investors, financial intermediaries, and entrepreneurs for liquidity and safety. The second solution is risk management and diversification. Financial markets are becoming more integrated and interdependent, thus increasing the probability of expeditious contagion effects and leaving little room for swift measures against unexpected risks. Insufficient understanding of the new environment can create a sense of greater risk, even if the objective level of risk in the system remains unchanged or is even lower. The current wave of capital market liberalization and globalization is prompting the need for enhanced risk management measures, especially for the developing economies and emerging markets. The third solution for Islamic financial industry is non-bank financial services. There is a need to broaden the scope and range of financial services offered, similar to the concept of financial product supermarket that act like an all-in bank covering all sorts of financial services. Islamic Bank will serve as one-stop shop catering to different types of customers, ranging from private individuals, institutions, high net worth individuals, and corporations, and offering products that serve their investment, borrowing, risk management, and wealth management needs. The financial product supermarket will be a retail firm that manages assets and offers payment and settlement services. The last recommendations for Islamic financial industry is development of capital markets. The capital market need calls governments to undertake strong leadership and constructive policy actions. Well-developed Islamic capital markets will not only benefit borrowers and institutional investors, they also can enhance the stability of Islamic banks, providing them with improved portfolio, liquidity, and risk management tools. These developments will help to integrate Islamic financial markets, as well as the institutions that form them, into the broader conventional international financial system. In conclusion, there are several parts in Islamic banks and other Islamic financial institutions that deserve immediate attention and should be amended in order to help Islamic banking and financial industry to move further in the future. Okay, that's all from me. Thank you.